Here's something most retirees never hear about until it's too late to matter. You walk into your bank, you ask for $12,000 in cash. The teller counts it out and hands it over. And while you are walking to your car, your bank is already filing a federal report on that transaction. Not because you did anything wrong. Not because they suspect you. Because the law requires them to. Every time. No exceptions. No warning to you. That report has a name. It is called a currency transaction report. Banks file it automatically with the federal government anytime you withdraw or deposit more than $10,000 in cash in a single business day. The threshold has not changed in decades. It is not going up. And it has nothing to do with your age, your income, or your credit history. It applies the same way whether you are 32 or 73. But here is the part that quietly trips up honest people who are just trying to handle their own money. When a senior hears about this rule for the first time, the instinct is often the same. That thought, that logical, seemingly harmless thought, is where ordinary people accidentally cross into federal crime territory. And that is exactly what I want to talk about today. My name is William Hayes. I am an enrolled agent, and I have spent more than 20 years helping retirees work through IRS rules, banking regulations, and the kind of fine print that the government publishes, but nobody ever explains. Not your bank teller, not your financial advisor. That is what I do. If you are somewhere between 60 and 80, if you have a pension or Social Security or a retirement account, and if you have ever thought about pulling a large amount of cash for a car, a roof, a grandchild, an emergency, this video is for you. Please watch it through. Because the law I am about to describe is not complicated, but the trap it sets is very easy to walk into without realizing it. Before you go anywhere, if this kind of content is useful to you, hit the subscribe button. I publish videos specifically for Americans in their 60s, 70s, and beyond who want to understand the real rules around their money, their Social Security, and their taxes. No jargon, no selling anything, just the facts. Now, 2 myths. Let me clear them both up right now, because I hear them constantly, and one of them is harmless, and one of them can land you in federal court. Myth number 1. If my bank files a report on my cash withdrawal, it means I am under investigation. False. Completely false. A currency transaction report is a routine administrative filing. Your bank sends it to a federal agency called FinCEN, the Financial Crimes Enforcement Network, part of the Treasury Department. FinCEN collects these reports. Thousands of them every single day. The report contains your name, the amount, the date, and the account. It goes into a database. That is it. There is no alarm that goes off. There is no agent assigned to your case. There is no letter sent to you. The IRS does not get automatically notified. For the overwhelming majority of people who trigger a CTR, nothing happens afterward. You withdraw your $12,000, you pay your contractor, and that is the end of the story. The CTR is not an accusation. It is a record. It exists so that law enforcement, if they ever have a specific reason to investigate someone for a real crime, can look up that person's transaction history. If you are not involved in a real crime, the CTR sitting in FinCEN's database does you no harm at all. None. Myth number 2. I can just split my withdrawal into 2 trips to stay under $10,000 and avoid the whole thing. This is the myth that ruins people. Because that strategy, deliberately keeping each transaction just below the reporting threshold specifically to avoid triggering a CTR, is called structuring. See 5324 of the Bank Secrecy Act. It carries penalties of up to 5 years in federal prison and fines up to $250,000. And here's the part that shocks most people. It does not matter that your money is completely legal. It does not matter that you have paid taxes on every dollar. The crime is the intent to avoid the report. That is it. The source of the funds is irrelevant. So myth 1, the report is harmless. Myth 2, trying to dodge the report is the actual crime. Let me explain the law itself now, because understanding the structure of it will make everything else make sense. The Bank Secrecy Act has been federal law since 1970. Congress passed it specifically to create a paper trail for large cash transactions that law enforcement could use in financial crime investigations. Over the decades, it has been updated, expanded, and enforced more aggressively, but the core rule has stayed the same. Any financial institution, your bank, your credit union, your savings institution, must file a currency transaction report for any cash transaction that exceeds $10,000 in a single business day. The form is FinCEN Form 112S, Department of the Treasury. According to FinCEN's published guidance, the $10,000 threshold covers not just a single withdrawal, but the aggregated total of all cash transactions by or on behalf of one person in a single business day. So if you take out $6,000 in the morning and $5,000 in the afternoon, same bank, same day, that triggers the CTR just the same. The bank is required by law to aggregate those transactions and file. The CTR is not a tax document. It does not change what you owe the IRS. It does not trigger an audit. The IRS has access to FinCEN data under specific circumstances and with appropriate legal process, but a CTR being filed on your account is not in itself an IRS event. You will not receive a Form 1099 because of it. You will not owe additional taxes because of it. The report simply records that the transaction happened. Now, banks are also watching for something else. Under the Bank Secrecy Act, financial institutions must file what are called suspicious activity reports, SARs, when they observe transaction patterns that seem designed to evade reporting requirements. A suspicious activity report is different from a CTR. A bank does not have to wait for a transaction to exceed $10,000 to file a SAR. If they notice a pattern, say, a customer who has never withdrawn more than $2,000 suddenly making repeated withdrawals of $9,500 over several weeks, the bank's compliance department will flag it. They do not have to tell you. They are legally prohibited from telling you. The SAR goes to FinCEN, and it may eventually reach law enforcement. That is how people who thought they were being clever about their cash get caught. Not because of the CTR, but because of the pattern. The other form worth knowing is IRS, Form 8300. This one is different from the CTR. Form 8300 is filed not by your bank, but by businesses. If you pay a car dealer, a contractor, or any trade or business more than $10,000 in cash in a single transaction or in related transactions, that business is required to file Form 8300 with the IRS within 15 days. Gov. So if you are paying a roofing contractor $12,000 in cash, your bank may file a CTR when you make the withdrawal, and the contractor is legally required to file a Form 8300 when they receive it. Two separate filings, both routine, both pointing to a perfectly legal transaction. What actually happens after a CTR is filed on your account? For most people, in most situations, nothing. The report sits in FinCEN's database. If you are a retiree who withdrew $14,000 to pay for a new roof, and you have the contractor's invoice and receipt, you are simply not a person of interest to law enforcement. The CTR is routine. The danger is self-inflicted. It is only created when someone tries to dodge the report and creates the pattern that actually does attract scrutiny. Let me tell you about a man I will call Frank. Frank is 73 years old. He lives in Columbus, Ohio. Worked 31 years for the County Highway Department, retired on a pension and Social Security. Modest savings. His house has been in the family since 1987, and the roof is shot. 3 estimates came back between $14,000 and $17,000. Frank wanted to pay cash. He has always paid cash for big things. Does not like financing anything. Does not trust wire transfers. Fair enough. Frank had no idea. He got nervous. He thought, I haven't done anything wrong, but I don't want the government looking at me. His fix was to take out $9,500 this week, $9,500 next week. He figured that kept him under the $10,000 and nobody would know. This is a composite story, one I built from the kinds of situations that come through IRS practitioner communities and are reported in federal court records. But the pattern is real, and it plays out across the country every year with ordinary retirees. What Frank did not know was that his bank's compliance software was already flagging his account. 2 transactions of $9,500 in 2 weeks, from an account that had never seen withdrawals larger than $800. That pattern, the sudden appearance of just under 10,000 withdrawals, is exactly what the Bank Secrecy Act's suspicious activity report provisions were designed to catch. Frank's bank filed a SAR, not a CTR, a SAR. because the pattern looked like structuring. Frank did not intend to commit a crime. He had never heard the word structuring in his life. He was just trying to pay for his roof with his own money without attracting attention. The irony is that if he had simply walked in and taken out $15,000 in one shot, the bank would have filed a routine CTR, Frank would have handed it to the roofer, and nobody would have looked twice. The honest fix for Frank, and for anyone in the same situation, was simple: walk in, make the one withdrawal, keep the contractor's invoice and the receipt for the work. If anyone ever asks, "Here's what happened. I needed a new roof. Here's what I paid. Here is the receipt." Full stop. A legitimate cash transaction with a clear paper trail is completely defensible. It is the attempt to dodge the report that creates the problem. Now let's talk about what you actually do if you have already been in a situation where you may have created a pattern. First, do not panic. A suspicious activity report does not mean charges have been filed. It does not mean you are under investigation. It means your bank sent a flag to FinCEN. Many SARs are reviewed and closed with no further action because the underlying transaction turns out to be clearly legitimate. Second, get your records together immediately. If you made multiple cash withdrawals and you used that money for a real documented purpose, a car, a roof, medical expenses, a family gift, gather every receipt, every invoice, every written estimate, every bank statement. A clear paper trail connecting the cash to a legitimate purpose is your best protection. Third, do not make any more transactions that resemble the pattern. If you realize what you did looks like structuring, stop. Further transactions that fit the same pattern, dig the hole deeper. Fourth, consult a professional. If you have received any correspondence from a federal agency, or if you have reason to believe law enforcement has been in contact with your bank about your account, you need to speak with a tax attorney or a federally authorized practitioner before you do anything else. Not a family friend, not a financial advisor. Someone with credentials who can communicate with the government on your behalf. Fifth, understand what being reported actually means for most people. If your bank filed a CTR on a legitimate withdrawal and you have done nothing unusual, you do not need to do anything at all. The CTR is not a notice to you. You will not receive a copy of it. You do not file a response. It is simply a record that sits in a federal database. Most of the time, for honest people, that is where it ends. If you have received an actual letter from the IRS or from the Department of Justice regarding a specific transaction, that is a different situation and you need professional help immediately. But a CTR by itself, that is just the routine filing your bank makes on every large cash transaction. It is not a bill. It is not an indictment. It is paperwork. Here is what to do this week if you are planning a large cash withdrawal or have one coming up. Step 1. Make the one withdrawal. Do not break it up. If you need $14,000 for a specific purpose, withdraw $14,000 in one trip. Let the bank file the CTR. The CTR is routine. Routine is fine. Step 2. Document the purpose before you go. Before you walk in to make that withdrawal, write down what the money is for. Keep the contractor estimate, the car sale agreement, the bill of sale, whatever it is. Put it in a folder. Date it. This paper trail is what connects your legitimate withdrawal to your legitimate purpose. Step 3. Ask your bank what triggers a report if you are unsure. Bank staff are not allowed to tell you in real time that a CTR is being filed, but they can explain generally how the reporting rules work. Gov that explains the CTR in plain language. Read it. Step 4. Consider a cashier's check or a wire transfer instead of cash for very large amounts. If you are paying a contractor or a dealer, a cashier's check creates a paper trail automatically. It clears the bank's records, it clears the contractor's records, and there is no cash handling involved. For amounts above $10,000, this is often the cleaner path. The choice is yours, but understand the options. Step 5. Never structure. Do not split. Do not spread withdrawals across multiple banks to stay under the threshold. Do not ask family members to make withdrawals on your behalf to avoid the report. See 5324, Federal Law. The penalty is not a fine. The penalty includes federal prison. And courts have repeatedly held that you do not need to know you are committing a crime for structuring charges to stick. Intent to avoid the report is enough. Large legitimate cash is fine. The CTR is routine. The problem is never the withdrawal. The problem is trying to hide it. This is general education, not personal legal, tax, or financial advice. These rules really do vary by state and by income. Always confirm your own situation with your county, your state SHIP office, the IRS, or a qualified professional before you act. Being legally entitled and actually having the money are two different things. The only bridge between them is the form, and the agencies are not going to build it for you. So we will. If this helped you, share it with someone you know in their 60s or 70s who handles their own finances. They may never have heard of the CTR, and this one video could save them from a serious mistake. And in the next video, I am going to show you a 2025 change to the standard deduction for seniors that makes Social Security income completely tax-free for many people over 65. That one is worth staying for.